Hey guys, welcome back to Wall Street Weatherman. I'm Greg, and it's great to see you again. Today is November 21st, and I put on my show outline, let's get wonky, because uh, I, I want to, I'm going to get a little bit, I don't know, into the a little more technical stuff about what's been happening with the market lately, but I truly find this fascinating. And so I want to look back over the last 6 or 7 weeks and talk about a few things that happened that have rolled into today and helped to make this quite a crazy week in trading and in the last what we talked about Nvidia and the tech trade and the wild price swings and everything that's led into that. So this goes back to October 6th, and it starts with Bitcoin and speculative stocks, and it incorporates the algorithmic computerized training that occurs today, and it involves a software bug as well. So those are the teasers for this story to unfold. So on October 6th, Bitcoin was $125,000 per Bitcoin. As of today, November 21st, pre-market this morning, it touched 80,000, just about $80,000 from 125 down to 80. It's been heading down and heading down fast lately. So that's October 6th at its high. A few days later on October 10th, what began everything was another tariff scare of 100% tariff being put onto China by the United States. And stocks um, reacted and started to sell. And so did Bitcoin. And the up until that point, the more speculative trades had been running and sort of on a steep incline, which is always something to keep an eye on when something really goes parabolic. In other words, like a jet taking off, just the slope of the line really starts to increase. Um, that's something to keep an eye on because uh, things I not that I prefer, but a nice steady growth pattern is a little more stable versus something that goes ballistic and can come down quickly and all of that. Anyhow, those speculative stocks, um, such as the nuclear energy play and also quantum computing. Those that had a really nice, run and acceleration, those started to sell off as well. Now, in that speculative trade, that trader is also um, uh, also trades in Bitcoin, just sort of making a basket of that speculation trade. So Bitcoin, the speculative stocks, and that kind of trader also works on margin. In other words, they and leverage. They borrow money and they trade on that borrowed money. And so that's always something that we've talked about before about working on credit and when there's a credit moment or crisis or pressure, how that can exacerbate events and trading when people have to trade. So what happened was there was all that selling pressure, and the there was a stable coin called Athena, which a stable coin, just to review, is tied to the US dollar, 1 to 1. And what happened was during this selling uh, event, that stable coin had a software bug in it that momentarily dropped it from a 1 to 1 parity with the US dollar down to 65 cents. And when it did that, that's when the computerized training kicked in, the algorithms kicked in, and and called, did a margin call on a couple of million different accounts, Bitcoin accounts, It's called ADL. It's auto deleveraging. Again, the computer jumped in when that happened and sold off, started selling off, liquidating, calling the margins, calling the margins in of what was borrowed and closing out those accounts and selling their Bitcoin, which put more pressure, downward pressure on the price. And this happened started on one exchange, the Binance exchange, and it spread to other exchanges. By the time it was corrected, which wasn't that long, it had affected about 2 million different accounts and had liquidated $19 billion of Bitcoin. And so it really started accelerating the drop in the price. Okay, so two big players then added some fuel to that selling pressure. One were the market makers. The market makers bring together the buyers and sellers, and they provide the liquidity for the transactions and also the price stability. Okay, but when the prices were going down so rapidly, in order to keep that liquid, stable price market together, they needed to raise some cash and so they needed to sell some Bitcoin in order to keep their liquidity and stability in making those markets. These institutions did. That was one thing that put further downside pressure on prices. But then you had very large holders of Bitcoins, which back in the day, we used to talk about Vegas and the whales, which were the high stakes, large, gamblers that would come and slap down a bunch of money. But anyhow, these large Bitcoin holders that hold over $1 billion worth of Bitcoin, um, they fall into that category. Not there's no, but by and large, they fall into that category of the leveraged trader that is trading in Bitcoin and some of the other more highly speculative trades. So they as well needed to sell some Bitcoin to raise some cash so that they could balance their portfolios and hedge against the downside on their long holdings of that Bitcoin. And so they can't just do that on, for example, the Chicago Mercantile Exchange. They can't, the contracts are too small for them. So they have to go to the most liquid part of the market where they can get the transaction done and it has the liquidity for that. And the center of all that is a company called Strategy. They used to be called MicroStrategy, and they changed their name. Michael Saylor is the one that runs it. And so there was an incredible amount of selling of the Strategy stock. Um, and MSTR is the stock ticker, and MicroStrategy, but it's now called Strategy. Anyhow, their stock has fallen by 2/3 since then. So there was so much selling, and people had to find the place where they could sell, and that affected that company. And so you can see how these things can cascade. Like I said, $19 billion you know, just called like that, just in a moment because of some software and some computerized training. So that's selling uh, from the more highly speculative trades. Um, you know, the nuclear stocks um, and the quantum computing stocks. Uh, that created this cascaded selling event, and um, that's been occurring over the last 5 or 6 weeks. And then that brings us into this week when you suddenly had a rethink of the artificial intelligence trade and the return on investment of all of this capital expenditure that these massive companies are spending and spending on data centers and artificial intelligence, and people are suddenly saying, well, wait a minute, is this going to have a return on investment? And then, of course, we had the Nvidia earnings 2 days ago, which blew blew the numbers out of the water. And still, the next day, the stock had wild swings, and we've been in this crazy kind of market through today, through the end of the day today, which is Friday. And so, I just wanted to point out to uh, how a few events can roll into other things and then again snowball. And this is not a scare tactic. This is not uh, saying that we're going to continue down. As a matter of fact, before I flip the camera around to film this, the market had rebounded again very sharply from a down pre-market. It's been climbing its way back up, and looks like it's going to close in the green today, which is nuts, which is so crazy. So I wanted to talk about just a few takeaways, and then we're done. We're finished with this. But first of all, Bitcoin is a correlated risk asset. Okay. And this is important. This is important because originally, when Bitcoin was conceived and implemented and adopted, it was widely discussed as a safety trade to the risk trade in the market. In other words, the swings of the market. It was often called digital gold, and implying that it was a place to find safety in a volatile market. But as of this year, that is no longer the case. Bitcoin trades as a risk asset, like the market, moving up and down in in correlation to the market. So that's one takeaway. The other one is what I just talked about, that the effect of cascading events. And I can't help but think about, I go back in time to the great financial crisis in 2007, 2008, when the housing market was built up on some on the financing and the insurance of the mortgage market and the credit default swaps, the risk. It was all built uh, on this structure, and I'm trying not to say house of cards, but as one thing collapsed, it led into another, and you've maybe heard about that domino effect. Well, this is an example, to me, of the last 6 weeks, 7 weeks of a real domino effect. Now, again, I'm not concerned about the overall market at this point. We've taken it on the chin a little bit, and there's been real crazy swings. But I wanted to point that out, how you can have that cascading effect, you can have that domino effect, and to put it one more way, the snowball effect. And one thing can affect another in the market. But again, some positives. Today, we see some positive price action coming out of this. We'll see what it is when I finish this up and we watch the market close. But we've seen a rebound. That keeping that in mind, this is also one of those times when the market is so erratic that me personally, this is a time when, going back to number one and preserving our money, you can see a lot of opportunity in a very short amount of time. But what risk comes with that volatility? To me, that's not where I do where I like to do my trading, because honestly, it has, and I've been doing little test cases with very small amounts of money to see what's going on in the long and short markets and looking at option chains and all of that. But it is not, I prefer more stability. Anything can happen. Anything can happen. Let's just go back to Nvidia's report. Look at those incredible numbers. And the stock just shot up in the after hours and the following morning, and then came flying back down. The difference in price on yesterday, I guess it was, which was Thursday, from the pre-market high to the low for the day, was almost almost $500 billion, which is just incredible. I mean, that's the bigger than companies like MasterCard and Chevron and Procter and Gamble. It dwarfs just the move in that one day. My point being that when it's so violent and so unpredictable, uh, these sudden moves in the market, I take extra caution, and I'll say that this is when it is so hard, extra hard, to sit on my hands and to watch, to listen, to analyze, but not to make those moves. It's tempting, but it is so hard. So going back to our discussions about um, investor psychology, it is uh, it is a challenge. So this is when that discipline comes in handy. The discipline that we stressed before, that I stressed before, and then next week is a shortened trading week. It's Thanksgiving, so there are only 3.5 days of trading instead of 5. There's Monday through Wednesday, the 3 days, and then closed for Thanksgiving, and then Friday is a half day. So fewer trading days. Normally, there's lighter volume, so not as much volume is being traded because, let's face it, people are, driving to the in-laws' house to do a turkey or whatever it is, and there's just not as much activity, not as much volume, fewer trading days, and this can be a good or a bad thing. I like to think that in a very volatile time, when you can reduce the volume and reduce the number of days that are available to trade, that it could provide for a nice breather. And I really think that the market, which I think has some great fundamental strength to it right now, is could use a little bit of a breather, and maybe a little, have some stuffing and some cranberry and just relax a little bit. But also that breather to me, and this is the last thing, that the last month has been really pretty crazy with the market. From April we were up and then up and doing well, and then the last month we're down a little bit, and we've bumped our head 3 times against the key levels for the market, for the S&P 500, and checked back against that. But fundamentally, the artificial intelligence questioning and all of that, and echoes of 2000 and the dot-com, B word bubble, uh, I don't buy it. These are real companies that have proven business models and real revenue, incredible cash flows, uh, like strong balance sheets, and so it's very, very different in that sense. Now, does this mean that next week or through the end of the year the market's going to go up or down or any of that? I mean, I don't make predictions. I look at all the factors and I assign them probabilities, but I don't do forecasts. I'm here to let you know what's happening, to try and make simple sense of it, which makes me kind of laugh and think about the beginning of this show, which I called, or didn't call, but just made a note of, let's get wonky. So I hope it's been wonky for you. And I hope that it shed a little bit of light on the events of the last, month or two and the effect about borrowing money and leveraging and high speculation and how things can bleed into each other and gain size and momentum and really start to suck the psychology of the market and take hold of it. So anyhow, that's it. And I hope that gives you a good picture of what I've sort of dissected over what I see happening over the last, number of weeks. And that's it for today's show. So as always, thank you for watching Wall Street Weatherman. I'll see you again soon. And I hope you have a great weekend. Cheers.